July 8, 1974, Riyadh, Saudi Arabia. A small team from the United States Treasury lands for a meeting that will not be publicly acknowledged for 36 years. No treaty is signed, no press conference is held, no vote takes place. But what is agreed to in that room quietly restructures the global financial system for the next 50 years. Fast forward to today. The United States is running a deficit of roughly $2 trillion per year. For decades, Gulf states, led by Saudi Arabia, recycled hundreds of billions of oil dollars into U.S. government debt. That steady, price-insensitive demand helped keep borrowing costs lower than they otherwise would have been. Between 2014 and 2023, Saudi Arabia's direct treasury holdings declined. In 2023, central banks bought more gold than at any time since 1967. Saudi Arabia joined BRICS. And for the first time since 1974, major oil transactions began settling outside the dollar system. None of those things individually break the system, but they all move in the same direction. If Gulf oil revenue is no longer automatically recycled into U.S. bonds, and the U.S. is borrowing $2 trillion a year, who absorbs the difference? And at what yield? That is not history. That is a live funding question. My name is Marcus. In the last video, we looked at SWIFT, the messaging network America used to isolate Russia in 48 hours, and why that use may have accelerated the erosion of its own power. Today is the another pillar of American financial dominance. Not the infrastructure that moves dollars, the engine that creates demand for them, every single day, automatically. 5 questions. Why is the petrodollar arrangement a structural turning point right now, not just interesting history? Why does the erosion of this mechanism matter to anyone holding dollar-denominated assets today? What specifically changed in the data between 2019 and 2024, and what does the trajectory look like? Who is structurally stronger as this arrangement shifts, and who is bearing a cost they have not yet fully priced in? And what are the exact signals that will tell you when this transition has crossed the point of no return? The last question has a specific numerical answer. I'll give it to you before this video ends. Quick question before we go in. In your view, should oil be priced in dollars? Yes or no, or is it already too late to matter? Drop your answer now. I'll come back to the most interesting responses at the end. The petrodollar arrangement has existed for 50 years. It has survived the Iran Revolution, the Gulf War, the 2008 financial crisis, 3 decades of Chinese economic rise. Why does it matter more right now than at any previous point? 2 things happened simultaneously in 2022 that have not happened at the same time before. First, Russia's swift exclusion and frozen reserves demonstrated to every oil-exporting nation that dollar-denominated reserve accumulation carries a specific geopolitical risk, one that the United States has now confirmed it is willing to activate against major economies. Second, the United States federal deficit reached a scale, $2 trillion annually, in a non-crisis year, where the petrodollar recycling mechanism is being asked to help finance a gap significantly larger than it was designed for. The system is slowing down at the exact moment it is being asked to run faster. That timing is not a coincidence, and it is not yet visible in the headlines. Here is the direct line between petrodollar recycling and anyone holding dollar-denominated assets. Gulf state sovereign wealth funds and central banks buying hundreds of billions of U.S. Treasuries annually, automatically as behavioral pattern rather than active investment decision, suppresses U.S. government borrowing costs. They are the price-insensitive buyer that makes the Treasury market function smoothly regardless of supply. When that buyer becomes less automatic, when Gulf states begin actively allocating to gold, to European debt, to domestic infrastructure instead of routing surplus automatically into treasuries, the price-insensitive bid weakens. A weaker price-insensitive bid means U.S. borrowing costs are more sensitive to supply. With a $2 trillion annual deficit, that sensitivity has consequences. Higher borrowing costs affect mortgage rates, corporate bond yields, equity valuations. The entire pricing architecture of dollar-denominated assets, built on the assumption that Treasury rates are the risk-free floor, becomes less stable if the petrodollar bid beneath it is unreliable. This is not theoretical. The directional data is already moving. That is what Q3 is about. The loop. Most explanations get wrong. Almost every article about the petrodollar stops at step 1. Oil is priced in dollars. That sentence is accurate, but it is the beginning of the loop, not the loop itself. Step 1. OPEC prices oil in US dollars, exclusively. Step 2. Every economy that needs oil, China, India, Germany, Japan, Brazil, must first acquire dollars to buy it. Not because they want to use dollars, because the commodity is only available in dollars. Step 3. To get those dollars, countries must either earn them through exports to the United States or purchase them on the foreign exchange market. This creates permanent, structural, baseline demand for dollars from every oil-importing economy on Earth. Step 4. Saudi Arabia and the Gulf states accumulate massive dollar revenues they cannot spend domestically. Their economies are not large enough to absorb hundreds of billions in annual oil revenue. Step 5. Those dollars get recycled into U.S. Treasury bonds. The Gulf states become among the largest foreign creditors of the United States, keeping American borrowing costs lower than they would otherwise be, funding deficit spending at an interest rate no other country could access. Oil demand creates dollar demand. Dollar revenues get recycled into U.S. debt. U.S. debt stays cheap. America runs deficits that would collapse any other economy. The cycle repeats. This is not a trade agreement. It is a self-reinforcing subsidy loop, with no legal structure, no treaty, and no formal enforcement mechanism. Just physics and incentives, running uninterrupted since 1974. The secret architecture, what the 1974 meeting actually was. To understand why the loop was built, you need the crisis it was designed to solve. In August 1971, Nixon closed the gold window. The dollar was no longer convertible to gold. The reserve currency of the world was suddenly backed by nothing physical. The credibility crisis was immediate and existential. If the dollar is no longer backed by gold, what backs it? Why should the world hold it? The answer came from the Riyadh meetings of July 1974. A small U.S. Treasury team flew to Saudi Arabia for a meeting that would not be publicly acknowledged for 36 years, unearthed by Bloomberg through a Freedom of Information request in 2016. The arrangement: the United States provides military protection and security guarantees. Saudi Arabia prices oil in dollars and recycles surplus revenues into U.S. Treasury bonds. The dollar didn't need gold anymore. It was rewired to oil. And unlike gold, which sits in a vault, oil has to be purchased every month, at industrial scale, with no physical substitute. Every country on Earth had just signed up for dollar dependency, whether they agreed to or not. 2022. Russia's swift exclusion and frozen reserves create a new risk category for every oil-exporting nation. Non-dollar oil settlement infrastructure, previously theoretical, becomes an active procurement priority. March 2023. Saudi Arabia officially accepts yuan payment for oil sales to China. The Wall Street Journal reports it. Chinese state media confirms it. Riyadh does not deny it. For the first time since 1974, a major OPEC producer has settled significant oil volumes outside the dollar system with a major buyer. January 2024. Saudi Arabia formally joins BRICS, the economic and political bloc explicitly organized around reducing dependence on dollar-denominated trade infrastructure. Let that register. The country that is the structural foundation of the petrodollar arrangement has joined the organization explicitly designed to provide alternatives to it. That is not commentary. That is a datable, public, unambiguous event. End of 2023. Non-dollar oil settlement reaches approximately 20% of global oil trade. In 2019, that figure was approximately 2%. 2% to 20% in 4 years. That is a direction. Directions in financial infrastructure, once established, do not typically reverse without a major structural intervention. And the Treasury data. Between 2014 and 2023, Saudi Arabia's direct U.S. Treasury holdings declined from approximately $123 billion to approximately $108 billion, a 12% reduction. Not catastrophic, but directional. More significant, Gulf states that previously recycled oil surplus automatically into treasuries are now actively diversifying into European sovereign debt, into domestic infrastructure, into gold. In 2023, central banks globally purchased gold at the highest rate since 1967. The largest buyers, emerging market central banks and Gulf sovereign wealth funds. Every dollar that flows into gold instead of treasuries is a dollar that is not suppressing American borrowing costs. That is a direct, measurable cost, paid by the U.S. Treasury, passed to U.S. taxpayers, and ultimately embedded in the pricing of every dollar-denominated asset. The power transition, named and specific. Structural winner, China and the Gulf states. China because yuan oil settlement creates structural demand for the renminbi that no amount of bilateral diplomacy could have manufactured. Gulf states because they have converted a passive mandatory recycling arrangement into an active investment decision, giving them leverage they did not previously hold over the terms of U.S. financial support. Structural loser. The automatic nature of petrodollar recycling, which is the specific mechanism that allowed the U.S. to borrow at below-market rates regardless of its fiscal position. The dollar remains dominant, but the price-insensitive bid beneath Treasury markets is becoming price-sensitive. That transition has not yet been priced into long-duration dollar assets. The winner requires precision to understand correctly. China's gain is not that the yuan is replacing the dollar. It is not. The yuan's share of global reserve holdings is approximately 2.6%. The dollar's is approximately 58%. China's gain is structural and specific. Yuan oil settlement creates a demand for renminbi-denominated assets, Chinese government bonds, yuan deposits, CIPS-settled transactions that did not exist at scale before 2023. Every barrel of oil settled in yuan is a transaction that requires a yuan-denominated financial ecosystem to function. Beijing is building that ecosystem. The Saudi decision to accept yuan did more to accelerate its development than a decade of Chinese financial diplomacy. And the Gulf states. For 50 years, petrodollar recycling was essentially mandatory. Surplus revenue flowed into treasuries because there was no credible alternative and no geopolitical reason to seek one. Both of those conditions changed in 2022. The Gulf states are now active allocators. They have alternatives: CIPS, domestic infrastructure, gold, European debt, and they have a geopolitical reason to demonstrate independence from dollar-only recycling, because Russia's frozen reserves showed them what passive dollar dependency looks like when the relationship with Washington deteriorates. They have not abandoned the dollar. They have acquired leverage over the terms of their dollar relationship. That leverage did not exist before 2022. And the loser, again, precisely stated. The United States is not losing financial dominance today. The dollar's reserve share, the depth of treasury markets, the liquidity advantage of dollar clearing, all of these remain overwhelming. What is being lost is the specific subsidy that petrodollar recycling provided. Price-insensitive sovereign demand for U.S. treasuries at any yield level, in any fiscal environment, regardless of deficit trajectory. The U.S. is now running a $2 trillion annual deficit into a treasury market whose most reliable sovereign buyer is becoming less reliable. That is the gap, and the market has not fully priced it. Here is a prediction question. What happens first? Dollar oil pricing drops below 50% of global trade, or the U.S. Treasury market faces a visible funding crisis? Drop your answer with the reasoning. I'm going to pin the most analytical response. Here is the specific numerical answer I promised at the beginning. The question is, at what percentage of global oil trade priced outside dollars does petrodollar recycling no longer reliably suppress U.S. Treasury yields? The honest answer: we do not know the exact threshold. Nobody does. It depends on what fills the gap and at what yield level. But we know the direction is moving toward that threshold, and these 4 signals will tell you when it is approaching, before the Treasury market prices it, before the Fed acknowledges it, before the headlines cover it. Signal 1. Non-dollar oil settlement share. IEA monthly energy trade reports. Current level, approximately 20%. Threshold to watch, 30%. At 30%, the volume of dollar demand creation from oil pricing drops materially enough to affect aggregate Treasury bid depth. The IEA publishes trade settlement currency breakdowns quarterly. Signal 2. Saudi SAMA and Gulf SWF Treasury holdings. U.S. Treasury TIC data monthly. Watch the direction, not the level. A sustained multi-quarter decline in GCC region Treasury holdings, even if the absolute level remains large, signals behavioral shift from passive recycling to active allocation. Available at treasury.gov tick data. Signal 3. Central bank gold purchases. World Gold Council quarterly. Threshold. Any quarter where emerging market and Gulf Central Bank gold purchases exceed 200 tons. Gold buying is the direct substitution. Dollars not recycled into treasuries are being held in physical assets instead. The World Gold Council publishes this data 60 days after quarter end. Signal 4. U.S. 10-year Treasury yield versus deficit spending divergence. This is the most important signal. If Treasury yields rise persistently while the deficit grows, meaning the market is demanding higher compensation to absorb Treasury supply, it means the price-insensitive petrodollar bid is weakening. This signal will appear in the yield curve before any political announcement. Track the 10-year on Fred at fred.stlewisfed.org. The petrodollar was not a market outcome. It was engineered, deliberately by a small group of people who understood that tying the world's most essential commodity to your currency would create structural demand that no competitor could replicate through normal market mechanisms. It is the most elegant financial architecture ever constructed. 50 years. No legal structure. No enforcement mechanism. Just the physics of a global economy that needs oil every month, at industrial scale, forever. The story I want you to leave with is not that the system is collapsing. The story is this. For the first time in 50 years, the system is operating in an environment it was never designed for. A $2 trillion annual deficit, a Gulf state partner that has joined an organization designed to reduce dollar dependency, and a precedent from 2022 that converted dollar-denominated reserves from safe haven to known risk. None of those three things alone would matter much. Together, at the same time, they are changing the behavior of the specific actors whose automatic decisions have kept this system running. The British didn't lose their telegraph cable monopoly in a war. The Spanish didn't lose the Peace of Eight in a financial crisis. They lost them to the slow, incremental construction of systems that made their dominance optional. Optional doesn't mean defeated. It means subject to competition. Financial systems built on monopoly power have never survived the transition from mandatory to optional with their dominance intact. The petrodollar system is not yet optional. But the data from 2022 to 2024 shows, for the first time, that the construction of the alternative is funded, sovereign-backed, and accelerating. Watch the four signals, not because the transition is imminent, but because when it arrives, in the data, before the headlines, you will want to have been watching. That is what this channel is for. I told you I'd come back to the comment. Yes, no, or too late. My structural answer. The question of whether oil should be priced in dollars is almost irrelevant. Markets don't change reserve arrangements because of ideology. They change them because of incentives, alternatives, and the specific risk calculus of the actors involved. The risk calculus of the Gulf states changed in February 2022. Not dramatically, not irreversibly, but measurably, directionally, and for the first time in 50 years. That shift is not in the headlines yet. Now you know where to look for it in the data. The dollar's reserve status doesn't rest on petrodollars alone. It rests on a deeper assumption, that when the world faces a financial crisis, U.S. Treasury bonds are the safe asset. The refuge. That assumption has held for 80 years. There is now a credible, data-supported argument, coming from people inside major central banks, that the next financial crisis will be the first serious test of whether that assumption still holds. That video is next. Welcome to the geopolitics of money.